Yeah, thank you everyone for joining the this property insurance webinar. It's been a pleasure to inviting Julia from State Insurance Commissioner Office, and we also have Leighton, Jonathan, and Michelle at insurance brokers that are very experienced, who can also join the discussion. So thank you so much for joining. You know, CREA is a nonprofit organization to really focus on building the professional skills of Chinese American real estate professionals. And we're also, you know, love to talk and grow together with the community. We also want to thank our corporate sponsors, been very supporting us over this year. And yeah, without you know, further ado, let's I'm gonna turn the presentation into each speaker to have a quick you know, 2 or 3 minutes for self-introduction, and then we can kick off the presentation. Julia, you make a quick self-intro. You're on mute at the moment. Let me see.
Can you hear me now?
Yes, yes.
Oh, okay.
Julia, we can't hear at this moment.
So I called in as well. So I'm
hold
that...
on. I think I maybe the call in is muted. Just 1 second. Yeah, which is your number?
Hello, my number is a 213-503.
I think it's linked to your account. So yeah, I can hear it now. So good.
Okay. Okay, everyone, I apologize. I am out on the field today in another for another event that is coming up at 1 o'clock, and so that is why I'm having trouble connecting. So I apologize to you in advance for that. But I am Deputy Commissioner for Community Relations and Outreach for the Department of Insurance, and our job is to inform local communities about the work that the Department of Insurance is doing in regards to your you know, anything to do with the insurance market. And so I am pleased to be here with you. Thank you for the opportunity.
Thank you, Julia. Jonathan?
Yeah, Jason, thank you for the pleasure of being here, and to the organization. You know, it is so critical, you know, the services you all provide and you all's association to our community. So thank you for having us. I realize it's an important conversation. So Jonathan Wheat started out with Chubb, Zurich, and AIG, and so was an underwriter for 10 years in the beginning of my career. And so I've been working on the brokerage side as a team lead and producer for Epic Insurance Brokers for the last 2.5 years. And Epic is the 9th largest privately owned independent insurance brokerage in the country. And we have 5 members approximately on our real estate brokerage team down in Orange County. And we specialize in multifamily, commercial, and retail investors with assets, you know, kind of up and down the scale. So I think approximately we're at about 4 billion assets, and that represents 20-odd million in premium. So we're actively growing and looking to help you all kind of, you know, solve the solutions and be an advisor.
Thank you, Jonathan. Leighton, do you want to make a quick introduction about yourself?
Sure. I've been doing insurance since I was 18. My dad started originally Willow Glen Insurance, so I worked from him pretty young age. I've been doing the same thing for the past 8 years. We've focus specifically on multifamily, strip shopping centers, office buildings, self-storage, anything real estate involved. Recently, we're acquired by InZone. Just been doing the same thing though. So been helping a lot of property managers, investors, and looking forward to doing that more often, given the current circumstances.
Thank you, Leighton. Michelle?
Hi there, I'm Michelle Lynn. I'm an insurance broker on the property casualty personal lines side. So a little bit different from Jonathan and doing more residential. So up to 4 units, anything after that, you just go and call the other folks. But I've been very involved with the local real estate association, was a past president with CAREA several years ago, but just here to help you guys mitigate through this interesting insurance marketplace.
Cool. Myself, Jason Wang, I'm the vice president of Trans-American Real Estate Association. I'm also a commercial mortgage broker at a commercial mortgage banker at Slatt Capital, basically help placing commercial real estate loans together. Oftentimes, insurance becomes a headache at the closing process. So that's why for my purpose, my own purpose, I really want to have this insurance webinar to talk with the, professionals in the insurance industry, and also have the honor to invite Julia from the State Department of Insurance. Julia shared with me about some slides from the Department of Insurance. So I'm gonna turn the presentation to her to go over some of the topics, the most recent update, and the challenges we're currently facing.
Thank you, Jason. If you could please help me move the slides, I would appreciate it.
Yeah, for sure, we'll do.
I do it through my. Thank you. So I am pleased to be.
Julia, we lost you for a second.
Jason, if she entirely has connection issues, I'm sure Michelle or someone could provide some context to like the general insurance market stuff.
With that.
Julia, can you? I think we lost you for a second. Right, I guess let me just probably go through the presentation since Julia is having some audio connection issue. So the insurance market has been very challenging nowadays, especially in California. And it's not just California issue. We have property insurance troubles in Texas and Florida, which are the most active states. And since we're in California, then it's all the headline news. It's been extremely challenging. So I want to just go over the slides. But just right now, it's just the insurance cost has been going through the roof by a couple factors. One is the construction cost becomes very high, and then the just reinsurance harder to find, and also the risk grows with the wildfire and everything else. As you see on the news, like burst out the wildfire has been the biggest challenge in California for property insurance. And that's overall has resulting, it's been harder for insurance to bind in California. And regarding the who are the insurance the players that we need to, hang on 1 second. Here we go. Hi, Julia. I just give you the assign you the co-host. Yeah. I think the audio is not connected. Here we go. And there are like 12 insurance companies are taking the majority market share. And that covers basically 85% of the state total insurance market. And they are getting actually tougher and tougher to issue new policies. And as you can see in the next slides, those players are either increasing the premium significantly, or they pass new policies, or they limited the new issuance of policies. As we can see, State Farm, they're completely paused on issuing new policies. And farmers, they're only limited to 7,000 new policies per month. So and all the others are either have restriction or raising the premium significantly. And that has been, many of you have been facing the challenges. And later on, we were just gonna, there are some of the facts behind, why are we in this place? There are, the direct insured loss ratio has, California is above the countrywide average. California is at 73.9%, and the country is roughly 59.7%. And the direct underwriting profit, which is how the insurance company making money, is for them is tougher and tougher to make money in California. And as you can see that in California, they're actually negative by 13.1%. So they're losing money on issuing new policies in California. And overall, they're just not really make sense for insurance company economically to be active in California businesses. And that has been a very difficult for everybody as property owners and also lenders.
Jason, if you can hear me?
Yes, I can hear you now.
Wonderful. I apologize again. I thank you so much for taking care of this. Thank you for giving the overview in general. Overall, basically, at the end of the day, we're having the issue of insurance as it's a global issue. These companies are global, and so ultimately all of the devastation that we have seen due to climate change in different areas of the world, not just in California, have taken a toll. In California, in particular, we have seen that the direct losses that we have seen for insurance company have been, completely off the charts. In California, the loss ratio has been 73.9%. In comparison to the rest of the country. The direct underwriting profit has been minus 13.1%. And, in contrast, countrywide 3.6%. And so you can see here, basically just overall, the insurance companies as a whole have been losing stability in that sense. We can move on to the next slide. What that means for California and where how did we get here? The FAIR Plan was created by the state after the Watts riots of the 60s, because nobody was able to sell insurance or was selling insurance to the folks living in South Los Angeles. But that was established as a plan, so basically the insurance of last resort, and was built on having everyone that does business in the state, all the insurance companies that do business in the state, put money into a fund. And then that fund is what is used to pay out claims when, when that, whenever that is needed. And the thing about that is, that has worked fine because it was only a very small portion of the state. But now the FAIR Plan in some areas is the only thing available for people. And so one thing that we need to make absolutely sure that people are aware of is the FAIR Plan is not a state program. It is not run by the state. It is run by the insurance companies. They are the ones that are in the board, and they are the ones that make the decisions as to, what they can and cannot do, or how they run the FAIR Plan. The department does direct the FAIR Plan, like it works with other insurance companies, but it does not run it. It's not run by the state. For the top 12 companies, we have seen that their AM Best has downgraded their outlook for them because of their concentration in their risk concentration in California. So that is why we have seen that a large number of companies are no longer writing in high risk areas, because they need to be able to cover all of their consumer claims and expenses and make sure that they have a fair return. And the thing about it is that right now, they are just concentrated too much in some areas, and that is why they have limited the amount of insurance that they're selling in those particular areas. Along with that, we have seen that the rate filings have been a lot more complex and are taking a lot longer. And we have a system since Prop 103 in the state where an organization can come in and prolong rate filings when they decide that, oh, we don't want these companies to charge more than they have to. And so they have just an undue amount of sway in prolonging the rate filings. So you will hear from people, from insurance companies, saying, we're not getting the rate filings that we need. We can move on to the next slide. And what that means is when they say that they don't have the rate filings, what we are also doing is, if you saw in the previous slides, we have given several of them have gotten rate increases. Actually, most of them have either gotten their rate increases or have applied for rate increases. However, because of their risks are so much more intertwined with the market that it is not enough for them to be able to continue to write policies. So what the department has done was created the Safer from Wildfires framework, so that we as a whole can work together to decrease that risk for insurance companies to be able to sell insurance. So that was some of the very first things we did. So what we did was created this with all of the agencies that work with wildfire. So we brought all of the agencies in the state, all of the different groups that deal with this, and we came up with very specific things that people can do to protect their home, their immediate surroundings, and their entire communities, so that they then will be able to have less risk and be able to either get some type of support from insurance companies that way. In the next slide, you will see that we have these things are very specific that people can do. There are, these 6 things that are, very specific things. So people don't have to wonder, it's like, okay, well, how, what else do I need to do? Or how is it that, no, it was very specific things that you can do. And then it goes into, so it is very much so your home. On the next slide, you will see, what you need to do for your immediate surroundings. What are those things that you need to do? And then the last slide is on, the next one is on what neighborhoods can do. And so what the commissioner has done is that if you have done these things, work with your community as well, because at the end of the day, it doesn't matter how safe you are if the neighbor down the street has just horrible things all over, trash or, things like that around in their area, and they catch on fire, that whole community will catch on fire too, even if you have done your part. So this point of having a neighborhood associations that will get together and actually do something to reduce the risk, that will, if organizations have done that, if people have done that within their communities and have done the work with their home, then they are entitled to up to 20%, a 20% decrease in their premium from the insurance companies. And that is actually a rule that is part of that the commissioner has done, so that it is now, the law. So insurance companies must take into account all the work that you have done in order for them to, and they can give you a discount for that work that you have done. In the next slide, you will see that not only have we done this, but now the FAIR Plan is actually also making sure that the insurance discounts are being taken care of. And but we also found that in HOAs, for instance, need more insurance than the FAIR Plan has to offer. When the commissioner came on board in 2019, the commissioner made it so that in insurance, the FAIR Plan was able to provide insurance for double what it was providing. So for 20 years before, the FAIR Plan was only providing insurance for up to $1.5 million. In many homes here in California, that's nowhere near enough. So we increased that to $3 million. And then for commercial properties, increased that to $7 million because it was only at 3.5. However, now we also realize that for HOAs, they need a lot more than that. So we have worked with the FAIR Plan, and now we're offering commercial policies for HOAs and groups like that up to $20 million for their location. And then also, when insurance companies when they were telling people that they were not going to renew their insurance, they would say it was because their wildfire risk score was too high. So when consumers would ask them, well, how did you get to the 20 million? Well, how did you get to the risk, my risk score, and what can I do about it? They would say that's proprietary information. We can't share that with you because every insurance company has a different one. So what the commissioner did was actually change that so that now every insurance company has to tell you what your wildfire risk score is, if that is what they use to tell you that they can't insure you because of that. So they have to tell you what it is, how they came about it, and then you as a consumer have the right to come back and say, no, I appeal that because I have done the work. Now, if you have appealed it and they don't do anything about it, the Department of Insurance then comes in and they can work with you to make sure that the insurance company is taking that into account. If you go into our next slide, the commissioner has also created the first climate and sustainability branch within the department that is working on all of these particular issues that deal with insurance companies and how they work with not just with homeowners and businesses, but also what do they do with the funding that they have available, and are they how are they helping to combat climate change as well? So as part of the sustainability branch, we also created the climate insurance working group so that it's generating California's climate insurance report, and so which is basically going through looking at insurance companies and what they're doing to work with us as well. So keeping them accountable as well. And then we also partner with the United Nations to create the California Sustainability Insurance Roadmap that has helped us to create and is continuing to help us to create different things that will help mitigate the issue. So on the next page, we will see that what we are working now is we're working to modernize the insurance market. So trying to make insurance more accessible and creating a resilient market, and then also protecting the local communities from climate change. So the way that we're going to do that is, in the next slide, you will see we are going to ask insurance companies to write no less than 85% of the homes in those areas that are identified by the commissioner as being distressed. So those areas that I cannot find insurance at all, that they are either stuck with a fair plan or can't find insurance at all. So, you know, only if you, so for instance, if you write, let's say 100 policies within the state already, so then in those areas, you will have to write, you know, 85 policies there now, so that hopefully then the entire, you know, everyone else will also be able to then increase the amount of insurance that they'll be able to sell from there. Then we are also going to be making sure that those people who are doing the work to you know, to make themselves safer from wildfires, that they are the ones that are first to return to you know, to return to the regular market, to be able to get regular insurance, because nobody wants to be in the fair plan, because the fair plan is a lot more expensive, and it is also, not only is it more expensive, but then it is also provides for less coverage. So you still have to buy a difference in conditions policy if you're under the fair plan. So the expectation is that then these, if we, you know, if we're making insurance more available, that these homes that are doing their job of becoming safer and reducing their risk will be the ones that will be able to get regular insurance more quickly. Now, the insurance companies have also, you know, in the past, California has always asked insurance companies to tell us how they're going to determine their rates, looking at the previous 5 to 10 years of their losses. Well, because of the wildfires, because of all these different things that have been going on in the state, this is no longer feasible, because it's, you know, also because of the pandemic, because there are so many different things that have come together, that is no longer feasible and is no longer correct. So what the commissioner is looking into new models of catastrophe models, recognizing that if they can look into, rather in the past, they would say this entire zip code, we're not going to write in this entire zip code. So now we're actually going to be looking at what, you know, through satellite imagery and looking at very specific things. What are people doing to make sure that they're mitigating? And so then that way we'll be recognizing and giving people the appropriate rates. So we're actually working on catastrophe modeling. And then the other thing that insurance companies are dealing with is reinsurance costs. So insurance for insurance companies, right? And that is something that they get out of companies that are not based in California. They are actually based in, like, you know, in the Cayman Islands, you know, that kind of thing. So nobody regulates these insurance companies. And so those insurance companies will decide however they, you know, they want to sell reinsurance. So they will change prices tremendously depending on whatever they decide. So what we are looking into is how can we make sure that California, if California allows insurance companies to get reinsurance and pass that on to the consumer, that we are only paying for California, you know, California risk, that we are not paying for people in Florida, people in Texas or India, you know, but rather that we're only doing that. And a part of this is also we're going to be modernizing the FAIR Plan. So we are expanding the $20 million to $20 million per structure, because, you know, HOAs are now looking at, it is not enough, the $20 million for their entire thing. They need every, you know, every structure. So that's going to be the next thing that we're doing. So this is the gist of the entire plan moving forward right now. The next slide. We just want to make sure that, you know, people, you know, that you all understand this is something that we have been, is the biggest change or reform that we're doing to the department, and how we do business with insurance companies, and you know, throughout the state. We have done We have held over 2,000 meetings, town halls, events in all 58 counties of the state, making sure that we understand exactly what it is that communities are dealing with, so that we know how to, we are able to then use these things to make sure that we are being supportive of what every community needs in the state. So it is not something that we just came up with on our own, but rather it is something that we have been hearing from people like you who are dealing with this. We have heard from people in, realtors and insurance brokers that they have had things, deals like shut down because the insurance has become just, a very difficult issue to deal with. So we want to make absolutely sure that whatever it is that we're doing moving forward, we are working with insurance companies, with the public, to make sure that they are covered, but then also that insurance companies are going to be able to have enough to be able to cover and any losses if the state is in a major catastrophe. And right now, because if everyone goes into the FAIR Plan, we will not be able to deal with that, because the FAIR Plan then will then become insolvent, and then all insurance companies will be losing there. So it is not feasible for us to stay the way that we are. So that is why we are doing all of this. So in the next slide, I just want to make sure. Oh,
yeah, that's
okay. I just wanted to make
question.
sure that you all are aware that we have an 800 number where people can call and deal and talk to directly with an insurance expert who will be able to go over their insurance policy and help answer questions, but then also contact the insurance agency and work with them directly so that they are able to deal with whatever it is that they're dealing with. And so I appreciate your time, and I hope that that this was clear, but if not, I'm happy to answer any questions when we're ready. Thank you.
Yeah, thank you, Julia. So I have a question by myself, is how the Department of Insurance and Commissioner works. Is that every insurance company want to increase premium, they have to get approval from the Department of Insurance?
Yes.
Is that okay?
Yes, the department, so Proposition 103 was set up so that the Department of Insurance actually oversees and how every insurance company is asking, is charging for rates. So what happens is, in the past, insurance companies would, if whatever rate that they would need, they would apply for it. But the way that our system was set up, because of Proposition 103, was that if they asked for more than 6.9%, they would have to go into a hearing, a public hearing, and we would have to, and then we would have to go over, everything with a fine-tooth comb, which we already do. But the issue with this is that, and another entity can come in and say, we don't agree with it, and so they can actually go into litigation with this. So what insurance companies did was only ask for 6.9%, even if they needed 20% increases, let's say. So what would happen is, we would say, okay, you need 20%, but we'll give you the 6.9%. And then the minute they got their 6.9%, the very next day they applied for another 6.9%. And this was just it happened all the time. So when Commissioner Lara came on board, he said, this is ridiculous. This is because you're not getting the rate that you need. Everybody is losing in some way. And what was happening was that these agencies that were stopping everything were only using the same things that, let's say, the department said, well, we don't have enough information here, or we need, something else on something else. They would just copy verbatim what the Department of Insurance was asking for, but would use it as a tactic to just continue to stall the insurance companies or the whole process. And so because of that, at the end of the day, then these companies would charge the Department of Insurance for their lawyers' fees for them working on this, and then they would charge the insurance companies for their lawyer fees as well. So ultimately, these companies were making about $500,000 or so for stopping these these proceedings. So it was expensive for insurance companies. It wasn't working for the department. And so what the commissioner has done has made this into a transparent system now. So now you are able to go into our website and see what organizations are the ones that are doing this, how much money they have made out of doing this, and whether they have asked for something different or something, if they have actually stopped any of these increases. And what you will see is that no, none of these increases have ever stopped. They have just been tactics. And so that is the thing that has to, that is now hopefully going to be changing as well with the way that we are doing this now. So at this point, the commissioner has rejected, I believe, 3 organizations from doing this for some of these, but it is something that we all that every insurance company does have to go through and request. And the commissioner has asked all insurance companies to request what it is that they need. So that is why in one of my slides you saw that they are actually requesting a 20%, 30%, even higher, because that's what they that is actually the rate that they need.
Yeah, because I seen other states for example, in Florida, I heard clients saying that their insurance company raising the premium 300% at the renewal, which is for some really high hazardous area, it might be reasonable, but also really it's a high burden on the property owner, but also it's probably risk justified. Yeah, and now
so,
yeah.
Sorry, and I just so you know, you might hear from people who have gotten increases like this in California as well. But the reason that they do that is even though they only got maybe a 10% increase that they can do, this is for their entire book of business. So that means that maybe in some areas, let's say downtown LA, they don't need wildfire risk. They don't have wildfire risk. And so then these folks might actually receive a decrease in their insurance. But folks that are living right in the WUI, right by all of these mountainous areas that have caught fire in the past, those folks might actually get 300-400% increases, because it is through their entire book, it's not just 6.9% by itself that they will get.
Wow. Cool. Yeah, thank you, Julia. So I'm gonna continue this to the discussion section. So for audience, if you have any questions you want to get answered, feel free to kind of type them up into the Q&A feature in the Zoom. I set up a couple questions I want to ask the group, which is Michelle, Leighton, and Jonathan. Is like from your perspective, what have you seen on the overall insurance? I'm assuming you're working with bigger insurance companies, some like smaller insurance companies. Has there been any significant changes from your perspective? Michelle, you want to go first?
Sure. Yeah, we've seen quite a bit this year. The shakedown really started early on this year. Some were quieter than others. Definitely a lot of the carriers are limiting the amount of policies, just like farmers, that are going to go out. They have stricter guidelines around the agents, and a lot of, I would say one of the biggest things is a lot of carriers are terminating and suspending a lot of agents too. So really, it's getting harder and harder for us to find insurance policies for our clients.
That was no, that was a really good observation, Michelle, and I think that's part of what makes it really challenging. And from my space of the world, because and that's why I love your perspective, Michelle, because it's like if I had something that size, I would need to go to you as well. But from what I'm seeing in the brokerage world of, like, say, multi-family investors from 10 units to 5,000 or 10,000, or malls, right? So what we're kind of seeing is that, like, yes, there's been there are property insurance carriers who are leaving the market, and you have companies like Mercury or Farmers who used to kind of play in the commercial space, who've now either they've drastically increased the age of the building they're willing to insure, or they've totally stopped writing in particular areas. And so that's, from my perspective, it's really not just the wildfires, but it's the makeup of kind of the assets in California and a lot of deferred maintenance and capex that makes the properties very hard to insure. And then you have a litigious environment around civil suits that have just become a little bit unbearable for an apartment owner. If someone slips and falls, you're kind of considered guilty and until proven innocent. And so I think in this environment, carriers are just not making money, right? And I think there was a moratorium 2020 through 2023 for actually increasing rates through in the state of California for admitted carriers. And so what you're seeing is like, yeah, they're asking for rate increases, but you've gone through this large period where they've lost money, and so they just can't recoup that. And so I think it's a very challenging environment overall.
Agreed. The thing Jonathan pointed out, the age of buildings, that is one of the number one factors, eligibility questions that companies are coming with. You mentioned Mercury there. They want newer buildings, and so much of California was constructed in the 50s and 60s, and companies are saying, look, we only want stuff that was built 30 years ago, and that's like 5% of what's out there. And then again, kind of piggybacking on what Jonathan said, the updates, what companies are looking for, the roof, the electrical, the heating, and the plumbing being the top four. And again, we have some electrical systems that were used a lot in the 50s and 60s that many companies consider ineligible for their programs. And in prior years, it wasn't an issue. We weren't, there was companies willing to overlook that. And as companies have lost money, they have tightened underwriting guidelines tremendously, and they've increased premiums. I'm seeing deductibles get pushed up on renewals despite no claims, just claims being held against clients where it wasn't necessarily their fault, but it's a tough environment. And not to mention, just getting quotes back is difficult. These insurance companies, because of all these non-renewals, they're not staffed up properly to handle the amount of submissions they're getting. They're just inundated, and it is taking far longer than it ever has to, get a quote, even when you submit all the necessary information. So those all together have made it a pretty challenging time to be a broker.
Yeah, I think Leighton mentioned something. Yeah, go ahead. Sorry.
No, just to add, one of the things that you will start to see in the future, and it's already begun, is inspections. Used to be 1 in 10, 1 in 20, whatever it is. Every single property coming on new and every single renewal, they are sending tons and tons of inspectors out there. And if they find anything slightly wrong, you can try to correct it, but some of them are going to take long. I mean, like you guys, the commercial guy said, it's San Francisco, a lot of those properties built in 1920s, if not earlier, and the knob and tubes are a huge, huge issue. So, be prepared that these inspectors will come around through all next year, and people better start updating their properties, or else we won't find insurance for you guys.
Good point. And, I was kind of continue to the next question about, because every insurance policy is so complicated. There's so many, like, for example, different coverages, for example, loss of business income, or, deductible has been, can be modified to whatever's makes sense. I have a client for recent loan closing or a property in out of state that, the lender wanted the deductible to be lower from 50,000 to 25,000, and he has to pay 27,000 more every year for reducing that amount. So it's kind of, doesn't make sense. But I just want to hear from you guys, are there any specific coverages are harder to get? Or, the insurers are trying to play with those, mathematics or statistics to try to protect themselves, and which adding potential risk to the homeowners or property owners.
I think habitability is at least, I do a lot of multifamily, and so habitability claims are on the rise. And insurance carriers are wise that they take, it's about $10,000 is kind of what you got to write off for an individual plaintiff. And oftentimes, and then in a place like Los Angeles, we have tons of personal injury attorneys. You're going to look at a class action suit, and there's going to be major, for each person in the action suit, you're going to pay $10,000, regardless of whether there's merit or not. And so habitability is extremely, extremely hard to find when you're dealing, particularly with affordable or urban areas. And then environmental, I think is another one that is on people's minds because of mold. And there's a lot of endless area, and there's a lot of different ways that people get sick, and then they claim, allegedly, and some warranted and unwarranted, that mold has made them sick, and it creates a tough environment for those people to and to operate. So those are just two that I can think of, but.
Like for the personal line side, it's a lot of has to do with the replacement cost. Properties that are above like $1 million to 1.5, a lot of the carriers are stopping it. And they said they don't want to go beyond that limit. So you have to be very careful with which carriers are able to do it or not do it. So if you're in a high valued home, yeah, it's going to be very challenging. You'd have to do your homework way up front for those big properties.
I would add, Jonathan, 100% right. Habitability, extremely difficult, especially the older a building is, and the area it's in, as he mentioned that. Other things I've noticed, ordinance coverage can be tougher. Again, the older the building is, ordinance coverage is to upgrade your building, in the event of a loss. So think like fire sprinklers, seismic retrofitting, ADA compliance, those kinds of things you're seeing cities require now. And if you have a fire that could potentially be covered, that could be a huge loss for an insurance company. They don't want to give it to you unless some of those things have already been done. Other things you can see, assault and battery exclusions, firearms exclusions, those types of things you get in the surplus lines market. Is difficult to obtain that, and certain lenders, the Fannie Mae's of the world, don't want those typically. So there's kind of a disconnect between what companies are willing to offer and what the lenders want, and that's been a challenge as well.
Yeah. That's exactly what we're I'm facing in my field is that sometimes for fulfill the lender's requirement, it's been so difficult and so much more premium the borrower has to pay to get the loan closed. And I'm kind of curious from your perspective, is there any ways that obviously to fully explore the different, talk to the insurance brokers and, get a better option, really shop the policy, to the market. Is there any way that, for some to reduce their insurance premium? I think Julia mentioned something about, how to work on your home, your surroundings, and, the neighborhood. Is there any other ways that, you guys, seeing that people are doing to reduce the insurance premium?
I think the number one thing is upgrading your building, the roof, electrical, plumbing, and heating. Every company is asking about it. Another thing that all the companies are doing, at least been my experience, the underwriters, first thing they do is they type in the property address and they pull it up on Google Street View. And they look at that property and look at the surrounding properties. And they're looking for, is it painted? Is the landscaping done properly? I mean, is there trash? Is there graffiti? They are looking at it, as much as they can. And anything that they don't like, they are trying to decline. They are looking for right now the cream of the crop of the properties. That's how you get the preferred rates. And so really taking care of your building as respects what it looks like, the curb appeal. I think that goes a long way now. The driveway, another thing, trip and fall hazards. So really going over the whole property and what can I do to improve this, because it'll help with eligibility and your premium moving forward.
Yeah, I agree, because they have I'm hearing that they're sending out drones over the properties too. There's a lot of Google usage when they're looking at the roof. The automatic AI is saying, hey, roof doesn't look good from my point of view. And so therefore we may not want to, pass this review, and then you have a underwriting flag already. And then the carrier would have to take a look at it, or you have to prove to them that the roof was updated. So they are using the drones to look all the way around the properties. They are looking for construction stuff, anything that's left over on the property. And like you said, it was care of the property, condition of the property, and they want any reason to not to insure that property at that point.
Yeah, they've definitely, I'd say between the two, you covered most of like the remediation that can be done, in the short term. I think to get to your point about the insurance requirements, because we work on a lot of transactions. We do a lot of transactional work on large assets, and a big part of that is like understanding what's being required from an insurance perspective versus what really is needed, right? And so sometimes earthquake may be thrown in there. And so I think a large part of that is working with someone who's going to do earthquake modeling, is going to say, hey, they're requiring earthquake, but look, although this is in a particular area, we're not sitting over it's not really zone A. And so maybe it's not warranted. Like they want some special coverage from wildfire, but look, hey, it's wildfire. It doesn't model for this. So I think it's really understanding, or we're buying there's a lot of multifamily buildings on the same location. Can we put what's called the loss limit? Like, can we buy a certain amount of property, even though that doesn't cover the whole replacement cost, but we're covering what's, in the case there's a fire, we're covering the most likely circumstances of a catastrophe. So I think looking at having a more strategic view of your asset, or, your asset or your home, and thinking about what do they cover? What do they want us to cover? What do we really need to cover? And then figuring out if there's kind of a space in between those two.
And one of the audience had a question regarding the special flood zone properties. Have you guys seen, would that be, policy hard to get, or maybe, should people avoiding those properties in the special flood zones?
I don't think so at this time. The flood companies have been pretty stable, especially after this year, January, February, March, we had a lot of rain. So a lot of the flood carriers have kind of rearranged their premiums around that. But haven't been significantly seen any of those guys leave the marketplace. So you should be okay with flood zone areas still. We're okay.
Yeah, I don't think it's drastically, I mean, I wouldn't call it incredibly expensive, but if you tack it on to kind of the other items that are out there, I mean, it can be a meaningful chunk of your overall, total T-core, what we call total cost of risk. And, the kind of tricks that we typically try to use, I think first, depending on what limits they want, we're going to go to Cal, we're going to look at Cal Flood, and we're going to look at a pool, and we're going to get a small amount of limit, and then we're going to buy another excess amount over that, because the pools are going to offer some cheap small amount. And so an excess carrier will provide the limits for the rest of it. And so that's that's what we typically do to kind of mitigate those circumstances. And there's also, if it's really you're sitting in an area that you generally believe the risk no longer exists because the river's dry, or, they no longer have an aquifer there, then there are companies that you could work with that will come in and they'll give you an assessment. And if they believe that the maps can be redrawn, they'll put in the petition for you. And then any dollars that you save on the premium on a contingent basis goes to them, but that's all you pay. And so I have done it successfully in Los Angeles, utilized a company like this, and it ended up working out. And so I think that's another interesting strategy that can be deployed.
Yeah, agree with both Michelle and Jonathan. I've had some success with the land surveyors getting elevation certificates or getting a property taken out of a flood zone. I haven't seen any tremendous movement on the flood insurance carriers yet. They seem to be steady, but as we know, that can change pretty quickly. So yeah, doing all right for now.
Yeah, so Michelle has to run for another meeting, but Leighton, Jonathan, and Julia, I think we'll keep continuing our discussion. Michelle, thank you for joining us. And the next question is about the FAIR plan. I heard from some of my colleague or friends saying, some of the acquisition for homes has been significantly delayed, but because of the turnaround time for the FAIR plan, and to end up that place because they couldn't find insurers for the home, so they have to stuck with the FAIR plan. So what's the current turnaround time for a FAIR plan at the moment? Is there anything, people can do to expedite the turn?
So the FAIR plan is going through a lot of growing pains because they are receiving about 1,000 applications a day. And so they are, so they're having a little bit of growing pains. However, if you are having an issue, so I really can't tell you exactly what the turnaround time is right now. But if you are having an issue that you just can't get a hold of anyone at the FAIR plan or haven't really been able to get the assistance you need, contact the department and we will work with you and the FAIR plan directly. And we have someone that can, try to expedite things through the FAIR plan that way. So I would suggest that you you give us a call. We have, like I said before, we have experts that are on the phone during business hours at 8 a.m. to 5 p.m. every day, and they are able to help directly with you with that as well.
Cool. And for the FAIR plan, because it's been funded by insurance companies, and when they stop kind of issuing new policies or planning to leave California, would they stop the contribution to the FAIR plan?
So let me just make it very clear too. California is the largest insurance market in the country, and we are only second to China as a market for the insurance companies. So worldwide. So even though you will hear people say that they're leaving California, they're not leaving California. They are maybe stopping new policies until they are actually settled and they're able to to do this in a way that they are earning money the way that they're supposed to, or in a way that they feel that they're that they'll be profitable again. However, as of right now, companies are not straight out leaving California. So so understand that is that's where we're at right now. Also, you will be hearing from people saying, the entire time that I was talking and going over everything that we're doing, I did not talk about lower rates because right now what we have an issue of is availability. And so what we are working on is making sure that that insurance companies will continue to write and will write in areas that are needed as well. So that's what we're working on. So that, and the expectation is that once companies are now going to be able to, to start writing normally, that they will then, then you'll be able to have a little bit more competition. But as of right now, everyone has been kind of doing the wait and see until the market really, stabilizes itself. And so that's what we're working on right now.
Jason, do you mind if I give like a objective answer
Yeah,
to your CalFAIR question? Because so I've got 5 or 6 clients who I utilize commercial CalFAIR with, and I'm going to be honest, it's the absolute worst experience from a business owner's perspective or an investor's. I can't imagine the lack of the opaqueness and the lack of transparency is awful. There's no timeline. You have no idea where the submission is. You don't talk to the underwriter. You talk to a representative. I say it's about 60 days. And that's if you don't find out that they need to do an inspection or that, there's this building that doesn't fit in their criteria. And even after that, if they do an inspection, the process of like operating with the inspector and giving them the correct identifying items, the pictures, the updates, if you don't give that to them in a way that's nonsensical and bureaucratic, then they'll cancel the policy. And don't try to get a policy renewed because it's going to be awful. So I think if you're going to go CalFAIR and that's something we have to do, it's a process that's got to be done upfront as possible, because companies are like, I worked on the insurance side for 10 years. I have my CPCU. I've done reinsurance audits with our auditors when I was on the excess and surplus. So I mean, these are just capital allocators. These aren't like these aren't people who have some kind of like, discriminatory approach to how they do business. If they make money, they're going to do more of it. And if there's a way for them to allocate risk appropriately to different states and regions, then they'll do it, right? So, I think it's a very tenuous situation we're in with private insurers, and we have to be very careful, right? Because like we have, like a banking company like First Rep, right? First Rep went out of business, and they had real ERM issues with enterprise risk management, and that's the state California's in. And so there's going to be a real disruption in how we do things, and we need to make sure that doesn't really adversely impact our investors and our property owners.
All right. So one of the audience. I'm recording the Zoom meeting, so I'll post it online afterwards. So just we'll send out another email to the registrants. Barbara had a follow-up question regarding fair plan. Is the policy reviewing by fair plan being over 50 days? Don't know where's that. What suggestion do you have? Is it calling the Department of Insurance number, or any other suggestions?
Yes, I would suggest calling the department, telling them that, where you are, what is happening. Our number is 800-927-4357. And you are, and our website is there too. You can, if you don't want to talk to someone, you can do it online. But we do have people within the department that can help you communicate with the fair plan and try to expedite things. If you are in need of help with that. And like I said, because it is not a state program, we do not have control over it. However, we are able to call and see if we can get things expedited if needed.
Thanks. And the from another question is I'm curious from Leighton and Jonathan is have you guys noticing any requirement changes easing insurance wise from either property owners or the lenders? Have they become more flexible on, for example, deductible requirement? Have you noticed any changes on that?
Maybe a little bit. There's a little flexibility at times. Some of the lenders are understanding of what's going on in the marketplace. I would say there's still a pretty big disconnect. And I kind of understand from a lender's perspective. You want it to be protected, a certain way. You're protecting all this money you're giving up. So maybe a little bit of bending, but I wouldn't say anything very substantial, what I've seen at least.
Yeah, I don't know if there's any drastic changes. I think like what when you're talking about Fannie Mae or Freddie Mac, you're talking about money or LISC. There's going to be a different approach than when you look at like an institutional investor who's putting up equity. And they're drastically different approaches to how they're going to require deductibles to be structured. I tend to find that public agencies and public money are a lot more willing to step outside of certain bounds if it makes sense. While institutional investors, I find to be very, 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 very critical on insurance requirements and are so focused on the deal. And a lot of this is kind of has to do with like the availability of money and the cost of capital. But a lot of them are just kind of sticking it to LPs or GPs who are out there like investing on stuff and saying, hey, these are the insurance requirements, and if you can get the deal done, great. Like if you can't, sucks for you. So I still think having a good partnership with the agency that you're working with is providing the capital and doing it up front and being very honest about the insurance. I think doing that as soon as possible and having that conversation is kind of what leads to the best results.
Thanks. I have a audience question is about the process for Department of Insurance to approve the rate increases of the insurance company. What's the typical turnaround time, and has there a typical turnaround time, or is there any? I think you covered partially, Julia, is Department of Insurance trying to expedite the process. But has there been any significant improvement since this year as far as the turnaround time?
Yeah, so we do have, we do have a very rigorous review of all of these applications, and even though we don't have a particular, I can't really say, what would be the actual amount per company, because every one of them is different. And they each have, we have a lot of, there are a lot of questions that have to be reviewed. Everyone has been working on this. And if you recall, in September, if you, paid attention, that the governor did set out an executive order saying, telling the commissioner that, that, he needs to work on dealing with this, as soon as possible. And so what that did, it actually opened the availability for the department to get funding for staff to be able to increase the amount of staff that will be able to review these all of these files. And then also what it did was it allowed it, there's another organization that reviews all of our rulemaking and has to approve it. And so along with that, what it did is it made the Department of Insurance be the first ones to be reviewed, because this is something, it's basically a law review. They have to just make sure that all of that is taken care of, and that it's not discriminatory in any way. And so because of that, all of this is actually taking place in a much more much more expedited way. However, that does not mean that that we'll be able to finish this up within a month. Insurance, and not insurance, but basically government just works very, very slowly. The commissioner has given the department until the end of 2024 to get all of these done, which are all of the plans that he had set up on the sustainable insurance strategy by December 2024. And we expect that we will be able to get all of those things done. However, we also then depend on the insurance companies and how quickly they turn around what we ask for. So that's why I can't really give you a very specific date on when everything should be in place and insurance companies will be writing normally again, because it does have it doesn't just depend on the department, the insurance companies as well. But know that we do have we have been hiring, and we have been increasing the amount of work that we're able to get done because of this already this year.
So for some of the rate increases submitted, they have till end of 2024 to approve, or
no, it doesn't, no, not for the rate increases. Each one, we have, if you saw one of my slides earlier, we have a lot of them that have already been submitted, and so they are being reviewed, and they are being and so they come out every every so often. I really can't tell you exactly how much, when each one will be done, because each one is very detailed, and also it's and it depends on the insurance company as well. So it's not just the Department of Insurance. So I can't give you timelines.
I understand. Yeah. All right. Now, so I think I'm just, waiting on more audience to kind of submit questions. And here's, if Jonathan or Leighton have some questions for Julia from the, just, as open discussion.
I do have two questions. So,
okay.
So I understand that private insurers they do play a role in is it from the capital capital side, or is it from the administrative side? Because it seems to operate like a bureaucracy, or like, you know, whomever's operating it, it operates it poorly. I'm going to be honest, poorly. And then the contact with the underwriter, like, is there a way for the process along? And I'm sure that would slow them down a little bit, but to be able to contact underwriters directly.
So you're talking about the FAIR Plan?
Yes.
Okay.
Yeah.
I just want to make sure I'm like, I understand. So the FAIR Plan is, you know, so the commissioner has actually held some hearings about the FAIR Plan this last year. We held 2 hearings to review all of the issues that that brokers and consumers as a whole are having with the FAIR Plan, because it has been tremendous. And so what we did is we basically kind of got the FAIR Plan on the hot seat, in a sense, and just said, okay, here are the major issues. What is the FAIR Plan going to do to fix them, to be able to get to move things along? And the FAIR Plan has, you know, they have agreed to do several things. They have agreed to update their systems, because they hadn't updated their systems in about 30 years. And so that was a big issue. And so now that they have updated their systems, apparently, you know, the glitches that they're having because of the number of applications that they're receiving has actually been a major issue. And that's why they're having such a hard time on that end. But, you know, remember that the FAIR Plan, since the FAIR Plan is really, you know, run by the insurance companies, it has kind of been kind of like the ugly stepchild of this of the insurance companies, right? And so they haven't put money in it to upgrade it in years, you know. So there's that. But then besides that, there's also the whole when the commissioner came on board and he saw, you know, what the issues were, said, okay, you know what, the FAIR Plan needs to, for consumers, it makes no sense for them to have to buy FAIR Plan insurance and then buy a difference in condition insurance. So FAIR Plan, you need to just sell just general insurance, you know, full coverage insurance, and have that available. So what the FAIR Plan did is, instead of agreeing to do so, they sued the commissioner. And they sued the commissioner saying that he didn't have the ability to ask them for that, because he didn't run them, right? We have gone to, you know, we have been in litigation for over 2 years now, 3 years now, coming in 3 years. And we have won in every case, but the insurance companies basically are saying, if the FAIR Plan is run correctly, let's say, and I'm totally paraphrasing here, but if the FAIR Plan is run correctly and is selling, you know, insurance, you know, the way that we are selling insurance, then it is competing against us, and there should not be competing against insurance companies. And so that's their whole issue with it. And so what the commissioner has come back with is, well, then sell insurance. You know, if you're not going to allow the FAIR Plan to run the way that they're supposed to run, then you insurance companies need to be able to sell insurance. And so you need to do that. So it's either one or the other. Either we fix the FAIR Plan, or you sell insurance, or both. So we are working our darnest to get both right now for consumers, because it is not fair. Now, the thing about it is that, unfortunately, insurance companies are not utilities. They don't have to sell insurance. They don't have to do any business with us. So they can just say no. You know, and so then that's why we are, you know, we're doing everything on our part to try to find solutions here. And as of last week, we won that, you know, we won that case. And so now it's going to be, the FAIR Plan is going to have, I believe, until the beginning of the year to try to figure out how are they going to sell, you know, full coverage insurance. And that's going to be another, you know, another battle, I'm sure. But at least at this point, we're still moving them in the direction that they need to be. Not very satisfying answers. I apologize for that. But we are, but please know that, we are as a department with the limited, capacity that we do have, we are doing everything on our end to try to make sure that we are moving the needle in one way or another.
The fair plan isn't fair.
Not at all. And the commissioner has been very clear that it was, that it hasn't been for consumers.
So Julia, is the fair plan also including, does it include liability coverage for?
It does not.
Does not, right?
Right now. However, it will be with, the expectation is that next year it's going to start offering full coverage for homeowners. Right now, the fair plan only provides fire insurance. And so it is, that's why you have to buy another difference in conditions. So what insurance companies have been doing, they would say, sorry, I can't renew you. You're going to have to go to the fair plan. But hey, I'll sell you the difference in conditions policy. And by the way, it's going to be the same price that I was selling you the other one before. And you still have to buy the fair plan. So then they go buy the fair plan, which is much less coverage than they were having before. And the difference in conditions is still, so the insurance company is still making money, but and then the consumer is still missing out on what they need. And then they're paying 2 to 3 times as much. So it is not fair for the consumer. It's not doing well for the consumer. So that's why we're working to change that.
Yes. Jonathan, are you trying to say something?
Oh no, I have to run to a school board meeting that I'm already late for. But I very much appreciate the opportunity, and Jason, thank you to the association for having me. So let me know if you have any questions, and I'm happy to answer them. Future.
Yeah. Thank you.
Thank you.
Thank you, Jonathan, and everyone else. Thank you as well. I also have to run to my next meeting at 12:30. So thank you for your time. And if there is anything that I can assist with to help answer questions, our 800 number is there. We have people that answer the phone immediately. If you happen to hit it when everyone is on the other line, you will get a response with less than 1 minute. So they will call you back within the minute. So please give us a call or look into our website, which is insurance.ca.gov. Thank you for your time.
Yeah, thank you so much for everybody to join us. And Leighton, appreciate you joining us as speaking on the panel.
Sure thing. No, thank you for having me. I think we touched on a lot of the really important aspects of what's going on. I think everyone gave some good contributions. So hopefully everyone feels like they have a little bit better idea of what's going on. But if there's any other questions, glad to answer them or do what I can.
And we'll share the recording of the meeting and the slides on our CREA website. So we'll work on that and circulate those for you guys, the audience, future reference. Thank you so much, everybody. And we'll keep you posted on the future CREA events and webinars. Thank you.
Sounds good. Thanks.